Hey, take a look at this. This is a bull, okay? A lot of people are asking me, hey, Kevin, can you cover more bullish stuff? Are you always bearish? I'm like, no, many of you know I'm not always bearish. I've been bearish since July, and I expect to be bearish until at least right before the election. And then trust me, I want to go back to being a bull, okay? It's a lot easier. But at least in the meantime, people are asking me, Kevin, like, hey, you know, can you give us like some kind of like bull hope at least to look at? And I thought, okay, yeah, let's look at TS Lombard. And the reason I like TS Lombard is because this team over here, they're generally more bullish than what I see by others out on Wall Street. And I like balancing my views to theirs. You know, for example, Dario Perkins over here starts with, I've been in the soft landing camp for a while, and he's not going to abandon it now. Okay, all right, so we kind of know where this is getting started, right? He's telling us, hey, look, I'm a soft landing guy. And these guys are professional Wall Streeters. I love their insight. Honestly, I recommend everybody check out TS Lombard. It's hashtag not sponsored. I just like reading them. Like when I see their name pop up, I'm like, oh, I wonder what they have to say. Yeah, hopefully it's kind of like that for you, for me, where it's like, oh, me, Kevin video. Hopefully you come and learn new things every time, right? That's the goal. So I was reading this last night and I'm like, oh, I was not expecting this. So I want you to see how he's net bullish, but some issues that are coming up for him. Take a look at this. So I'm not going to abandon it now, especially after the Fed's 50 basis point cut. Mind you, with this 50 basis point cut here, there are a lot of people on Wall Street that say the left tail has been eliminated by the Federal Reserve. I actually think that's a pretty crazy how should I put it, complacent thing to say. I don't think the left tail is ever removed. But there were some analysts on Wall Street I was reading. They're like, oh, the Federal Reserve basically said, look, we cannot go to the left. The left is down, right? This is the down market. This is sad. This is like hyper runaway melt up amazing bullish economy, and then, you know, this is your sort of middle standard deviations here, right? Middle standard deviation 1, standard deviation 2. Okay, simple. The left tail is like everything goes to poopy doopy. And this analyst I was reading earlier today, they're like, oh, the Fed's eliminated the left tail risk, no left tail risk, this is great. And I'm like, no. The Fed has not eliminated a left tail risk until they cut rates by 200 basis points in an emergency capitulation cut, and then they cut another 200 basis points, and we're basically back under 1%. You know, then I think the Federal Reserve has actually stopped the left tail risk. Now, maybe they're signaling that they would be willing to do that, but I don't think they would be willing to do that until you have some serious pain in markets. So, you know, point of that, right, is just to say, like, hey, you know, the Fed could be there to bail you out, but the Fed's not going to capitulate and bail you out until something breaks and something actually has, like, a lot of pain for a while. The downside of that is if something has a lot of pain for a while, it means valuations are typically lower, right? This is why sometimes on days like today, I kind of just like trading. You know, this morning I threw in, right when data came out, we talked about it, I threw in this, see 7 a.m. is even where my screenshot is. I threw in this order here 5 seconds after the data came out. You could look at that timing. 82-cent purchase on the Qs. And this was my Tesla sell, which I made some profit on that, which was nice. But look at that. I sold it for $159, which was nearly a double. And I hit buy on that. I sent a notification to everybody in my Discord, puts. And CNBC comes on like a minute later. They start tanking the freaking market. It was like kind of funny. You got to beat CNBC to the news. But anyway. We try to do more of that. I think that's always entertaining. Remember, we have a flash sale in honor of that called Data Double going on until the end of the day today. And that trade held its value for like another 20 minutes or so. So like you didn't have to be really fast on jumping out. But eventually we did end up bottoming out on the Qs, and it was important to cover. But anyway, take a look at this. They say, I'm not going to abandon after the 50, you know, especially after the Fed's 50. That's fine. It's a commitment to not fall behind the curve, blah, blah, blah. But there are a couple things that are bothering me. I'm like, oh, interesting. A bull getting bothered? That's rare. Usually it's just like, it's just going to go straight up. Recent labor market trends covered in depth, we've been talking about these already, and the sudden, rather surprising relapse in global manufacturing. Okay, so both of these matter. We've been covering these either in the manufacturing ISMs, we've been covering them in the labor market, the temp layoffs, the peaking out of government and education employees, the peaking out of job openings, the number of people who are 27 weeks unemployed. Look that up, Google that one, and I'm telling you, it looks like you're in a recession. But anyway, and then a third thing that bothers him, central banks taking victory laps. Okay, interesting. So he's a bull, and he's like, we're starting to face some problems here. Labor market trends, manufacturing, and then the Federal Reserve basically trying to say, hey, everything's fine, we're winning. I actually agree with this. I think these victory laps are somewhat hubris, and I was a little nervous that I feel like Jerome Powell is holding back the concerns he truly has. And he's like, don't worry, everything's fine, to purposefully pump the markets because he realizes that if the stock market's up, you have a lower chance of getting layoffs. But you're built on Fugazi foundations then. Yeah, that's not great. But anyway, the cycle that fooled the consensus. This has not been a normal business cycle. And they talk about how leading indicators have given false signals, like post-COVID manufacturing recession. This was not a sign of a broader economic crash. The Phillips curve was wrong. The Phillips curve was suggesting we should have had interest rates up at like 9 or 10%. People thought a recession would be needed to cure inflation. No, it's just once you start lapping the price increases and everything's adjusted up, wow, all of a sudden you don't need more inflation unless you're printing more money. Okay, we knew that. That's fine. This is why we've been talking Nike swoosh recovery for a while. Beveridge curve, this has to do with the labor market, expanding labor force participation. Yield curve predicts policy easings, not necessarily recession. Well, the problem is usually when you come out of recession, you predict a lot of easing. It's because you are pricing in a recession. We're still not there yet. Usually you don't start a recession until you're 50 to 90 basis points uninverted, and we're at about 20 right now. Partial debt, sustainability, blah, blah, blah. Okay, so the biggest error so far, post-COVID, in calling for a recession has been underestimating the resilience of labor markets, or believing that central banks would have to destroy labor markets to get inflation down, which would cause a recession. Even now, there's still a chance that people are misreading labor market trends. Here, I want to focus on a different issue, global manufacturing. 2 years ago, it was easy to dismiss the weakness in manufacturing as a head fake. Okay, so basically, let me show this to you on the map. When you go down because of COVID. Okay, this makes logical sense. When you come back up, you go up because everybody's printing money like crazy. And then, of course, you're going to have a year-over-year comparison. So you're going to have some volatility after the remarkable recovery. What he's most concerned about right now, beyond the labor market weakening, which we've already covered on the channel, is this right here. This is his second big concern. He's going, wait a minute. This latest deterioration is actually more concerning. This chart is, in his words, and he's a bull, he's a soft landing bull, particularly ugly. Okay, that's not good, because this now means you've got the labor market that's poopy-doopy, and now you've got manufacturing that's turning poopy-doopy. That's not great. This is a lot of poopy-doopies. And then, of course, you have the oil market that, it bounced today because of Chinese stimulus. I mean, we knew the Chinese stimulus was coming. We weren't expecting it to be this big. This was great. Wonder what oil ended up. But the oil market is signaling some distress. It might be the same distress that you get someone like a Jamie Dimon arguing about of like, the market is pricing in perfection. I think I'm going to sit on the sidelines for this one. That's what Jamie Dimon says. Now, maybe it's because he's getting ready to retire or go on to, make a SPAC or something. Who knows? But, it's saying something when some of these big boys are like, I don't know, man, this is getting a little silly. But yeah, look, oil market's bottomed to a 3.5-year low 2 weeks ago today. Actually, I think it was 15 days ago, but whatever. You've had a nice rebound from 69 to 75. But you're talking an 8-9% rebound. Cool. You're still way lower than where you have been. I mean, here's the chart that they've given on this. And this does signal a downtrend, either if you draw it like this, or frankly, you look at, this sort of ceiling of highs that you're getting, this downtrend here. This is certainly recessionary. And it's, again, a sign of a weakening manufacturing base. 18 months ago, we could basically ignore what's happening in the global industrial cycle. Reopening from the pandemic had caused a massive pivot from goods to services and blah, blah, blah. This triggered a huge bullwhip effect in inventories, and manufacturing weakness didn't tell us anything. But now he's kind of like, I don't know, now we might be a little bit in sort of a leading indicator issue. See, this is why he shows up this U.S. leading indicator, 6-month annual change. And if you notice, we've recovered here in the leading indicator, but we're already starting to inflect back down. So it's like, was this drop right here just sort of counterbalancing the run, but now we're inflecting back down. That's what he's looking at. Then he says over here, so what's going on? Is this a sudden relapse and not part of the original fake cycle? Is this something to worry about? Is it a sign of monetary tightening finally starting to bite? Maybe, by the way. That would be a way of saying that suddenly you've got a Federal Reserve that has actually tightened because inflation has fallen so much. And even though they're not raising rates anymore, the excess increase in rates that we have is leading to a tighter environment. But global manufacturing capacity utilization, this is weird. They're basically pointing out here like, wait a minute, why are we normalizing here? We should not be capping out here, because if we draw a line from where we are and we draw it all the way back, and then you kind of just draw cross points, you're as bad as you were in 2012, over here in 2005, coming out of the 2001 recession, going into the Great Recession, close to almost a brief low over here in 2015 and then 2019. So you're at a pretty low normal level. If this is supposed to be a return to normal, this is odd. Obviously, China's economy looks worse than people have ever seen before. But then again, we got stimulus today. So who knows? Maybe that'll all of a sudden help China. But spring up manufacturing demand is what they're suggesting. But then again, would it support Chinese manufacturing or U.S. manufacturing, right? Probably Chinese manufacturing. But anyway, after 2 years of, listen to this, after 2 years of talking down recession scares, I'm conscious that I might finally be overplaying my hand. Listen to that. A bull is saying, damn. Okay, if you're bullish, he's basically, here's what he's doing. If you're a bull, he's saying, look, we might still stick to soft landing, but we should really start paying attention to labor. I mean, we saw what happened in the ISM report yesterday. Manufacturing, services, composite, all lower than expected. Not great. The beats were nominal and the lows were low. We saw what happened in the Challenger report from a couple weeks ago. That was a horrible jobs report. We saw what happened this morning on the conference board estimates. Not good. This is just some of the recent data. It just sort of compounds what you've been seeing. Beige book, 9 out of 12 sectors weakening. This is problematic. But what does he say here? As I keep saying, we are I think he meant to say in a more, but as I keep saying, we are in a more precarious situation now. And it is unsettling to see central bankers do victory dances. Okay. This is a big one, because I want you to just for a moment think about this. When central bankers do a victory dance, they're basically telling you, it's okay if interest rates go up. But wait a minute. Now you're not fighting the manufacturing pain or the jobs pain because you just let yields rise, which is like fully dumb. Like I want to say a word I shouldn't be saying, but it's basically it's kind of like fully R word, okay? Like we shouldn't be saying or even referencing these things. But for the Federal Reserve to suggest that, oh, we've declared victory, everything's good, and then all of a sudden you see this jump in yields, you are tightening on top of labor market weakness and manufacturing weakness. That is full dumb. And why does the market keep rewarding the Fed? Well, because the Fed is performing a victory dance. Central bank hubris is definitely top of cycle stuff. Yeah, that's not a good line. And this is a bull. This is a full bull here. But it isn't time to panic yet. Not until the Perkins rule triggers. Okay, the Perkins rule is sort of his version of the Somme rule, and he's like, the Somme rule might be triggered, but the Perkins rule hasn't triggered it. And then actually compares to Mrs. Somme too. This is his rule on unemployment. He's like, it hasn't hit yet. Okay, that's fine. That's fine. But let's just be clear. A bull is like, things are still okay, but we do have problems. Let me show you quickly the Perkins rule so you can see it here. So this is the Perkins rule revisited from August 26th. And let's just go right to his definition of the Perkins rule. So basically what you have here is, how does the Perkins rule compare to the Somm rule? It certainly has more false positives. Okay, so this is important, because if the Perkins rule triggers, it's bad. And he's saying his rule has more false positives. While it is rare for U.S. payrolls to decline outside of recessions, it does happen occasionally. Usually this is due to obvious distortions, such as extreme weather, but it also happened during the famous soft landing in 1995, when a shockingly bad employment report, later revised, prompted Alan Greenspan to cut rates. It also happened in the late 60s. Okay, well, hold on a second. In 1995, you may have briefly had a strong labor report, but in 1994, 95, and 96, if you read the Federal Reserve Open Market Committee transcripts, you will find what I saw as well, which is, for those 3 years, they do nothing but talk about how the labor market is so freaking tight, we might be causing a wage price spiral. And they only cut rates because they're like, all right, we don't see the wage price spiral yet. The jobs market's pretty tight, but, you know, and people aren't going out there to hire. They actually called some businesses discouraged as a reason for why they weren't hiring. But anyway, so then you look at this and he goes, okay, Perkins rule over here sees the Perkins rule false positive in 1995 and over there in the 60s. So it's clearly less functional than the Somm rule. But let's read what he says. The Perkins rule isn't foolproof, but that's not the point. The important thing is that when you look at every time the Somm rule is triggered since World War II, there were only 3 occasions where payrolls were not already negative: 1970, 1974, and 1980. Usually when the Somm rule triggers, the Perkins rule has already triggered. That matters because it's the opposite of what's happening today. The latest triggering of the Somm rule looks very different to the average recessionary experience. So he's making an argument here that basically, I mean, I hate to say it, but this time is different. But he is also saying that, like, hey, if this should be a bad flag, our indicator should have already been firing. Even if it's a false positive, it should have fired before the Somm rule. And so, his rule is made up of slightly different measures, and we don't know how useful or functional it actually is. But I want, again, you to show or you to see why is he saying this. Just to be clear, because I don't think I actually say it as clearly in this video, so I wanted to edit this in just to add a little bit more clarity. The Perkins rule is when the unemployment report comes in negative. Now, why is that important? Well, the Perkins rule basically triggers on a very simple basis. It's when the unemployment report, whatever it is, comes out, and it comes in with any negative read. So that is going to introduce a lot more volatility. So if we go jobs report, St. Louis Fred, let's just say, and we get the change in payrolls, we could just open up the chart and look and go, all right, cool. When is it negative and how often does it go negative? Well, an easy way to do that is you look for the change in thousands of people on a monthly frequency. So you just have to edit that a little bit on the St. Louis Fred website. And once you do that, then you could actually see how noisy it could be that you're negative. So it's a little easier to get rid of the pandemic here, because then you could see over here, oh, look, you were actually negative in 2003, in April of 2003, but the Fed had already capitulated at this point. You were bailing out, you were leaving the market at the point. You had a negative report, it looks like, here in 1997, negative 20K. You had a negative report right there, negative 7,000 in 1996, so that's another false flag. You had a negative 15,000 over here. I don't know that these one-off hits are that useful, because look how many false reads you get. False, 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 false. His Perkins rule, like, by the time we get the Perkins rule in this economy, we're going to have some major problems. Because look at this. What you're really looking for now is this downtrend that's happening here, right? I mean, even if you don't believe in technical analysis, I think we could all argue These are lower highs and lower lows. It's a down channel. Now, in case that's not particularly obvious, let's just smooth this out to the quarterly. Okay? Is that more obvious of a downtrend? Let's go semi-annual. Do you see the downtrend? Now, keep in mind, we only have the first half on here, so it doesn't actually show the deterioration yet in the second quarter. And so when you throw that in, you get that other pull down over here. So it doesn't look that flat. And then obviously, if you go out onto the monthly, you could see, we are somewhat stabilizing there in that June, July, August period. But a lot of people are looking at this and going, come on, man, this crop's probably already negative anyway. We can't believe their numbers. But imagine if their crazy numbers go negative. Ooh, it's going to be dirty. The trend is not your friend. And the Perkins rule is probably going to trigger pretty dang soon. Unless, of course, you think 150 BP cut all of a sudden is going to lead to some boom in hiring. So I actually wrote this down, a few weeks ago, and he says, there are several problems interpreting the SOM rule today. This is not a regular business cycle. Again, this time is different. The jobless rate comes from the household survey, which looks artificially weak compared to payrolls. And so this is where I say many would dispute this, given the households was more accurate post the BLS revisions. So I'm actually kind of, suggesting here that maybe the household survey is actually more accurate, than the payrolls report. But all the data is just a mess. It's hard to know what to believe. Strong labor force growth has driven most of the rise in the unemployment rate. It is harder to tell a reflexivity story when employment is still growing. So this right here is a labor force participation reference that, even if the participation rate stays the same, if you have a larger group of people participating, then you actually have more employment, but it looks like the unemployment rate is going up. So this is where he's saying, I'm not saying everything is great and investors should fade the R word. He's just saying the U.S. labor market does look increasingly precarious and is not great when you go into every employment report wondering if this data is going to show actual cracks, genuine cracks. The Fed needs to get ahead of this. Remember, this is from about 3 weeks ago. But the point again of showing you this was just to say that his take is the Perkins rule hasn't triggered yet. And the Perkins rule is going to trigger if you end up getting substantially lower payroll reads. In other words, we could just be one payroll report away from his Perkins rule triggering. And then you're starting to get to where you're triggering every kind of recessionary warning signal you could potentially ask for. Anyway. He says, just so you see it here, the Perkins rule, the idea that it is a contraction in employment that signals recession, not a gradual trickle higher in the jobless rate. Right. So, but this gradual contraction in employment is already what we're seeing from the Challenger report, from the ISM reports, from the Conference Board reports. So, anyway, out of all of this, what do I think? What's my bottom line takeaway? I'm watching this guy because he's a bull. And I think he's got logic. I agree with his tools. I agree things are really concerning when it comes to labor right now. But I also agree that there is a shot at a soft landing. He probably puts a soft landing at, a 60% chance. I put a recession at more like a 70% chance. So we're kind of flipped on that. But when that guy capitulates and goes bearish, that's when I know it's about to get real. And so we're not quite there yet. But as you can see, the way he talks, in his report 3 weeks ago, he's like, I don't want to, play down the R word. And then what's he saying this time? This time he's going, 3 things are bothering me. The sudden, rather surprising relapse in manufacturing, labor market trends, and top-of-cycle stuff like the Fed. So, again, when you combine all of this, I just can't help myself but go, I don't know, man, is this time to FOMO buy right now? Is this FOMO, all in? I think the risk is way too high. If we can give me, 2 or 3 labor reports, give me the September labor report. From what I'm seeing, it's going to be trash. Let me see if the estimates are out, by the way. Give me the September labor report. Give me the October labor report in November. and maybe even the December labor report. And if you really want to be sure there's no recession, give me the January labor report, because that's when you get like the seasonal layoffs and the start of 2025 layoffs. Although by November and the end of October, you should already have the warn notices for people who are supposed to get fired in January. So that's why I really think the end of October is going to be really, really interesting. Like, I wouldn't be surprised to see a lot of earnings where they're like, yeah, we missed on earnings and we're going to lay off a bunch of people in January. Oopsies. Maybe not. Maybe earnings will surprise nicely. But, you know, it's not going to take a lot to get these bulls to flip. And once we get nasty unemployment data, that's when they flip. And then it's too late to try to pick up a hedge. You know, I know I had a great day trade today. I doubled, my money in day trade. I don't know. It was somewhere between $25,000 or $30,000, which is great. That's a freaking great day. I don't always have great days. I can't guarantee that the days are always going to be like that, but it was a good trade, and I hope to send more alerts like that. That's my goal. And if you want to see what I'm trading, make sure you use that flash sale coupon code that's going on. But also how I'm positioning with hedges and how I talk about hedges on a daily basis, not shorts, but hedges. So let's see what's going on with jobs. So the jobs report comes out at the beginning of October. Let me see if there's an estimate for it yet. Unemployment rate. It's expected to stay flat at 4.2. Dude, change in private payrolls is expected to be 120. Change in non-farm payrolls is expected to be 140. If for some reason you get like a 95,000 or like a sub 100 handle, this market's gonna freaking tank. Yeah. I don't know. Because you don't actually need, like, think about this for a moment. Unemployment claims are generally aligned with the unemployment rate going up, but you could actually have a stable unemployment rate and potentially see less hiring if people are just more sticky at their jobs. And I think that's still going to be enough to create some poopy doopiness. So I'm nervous for the volatility. I'm watching what the bulls are doing. Every single day I'm trying to read what the bulls are saying, because trust me, I got the bear case down. All right, folks, I love y'all. We'll see you in the next one. Hey, what you got, Ken? I'm ready for you.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.